For the first time in 9 years, the Federal Reserve is expected to raise its key interest rate. While you may tune out some news from Washington, this is something that will affect you. If you've got a savings account, a lot of us do, retirement fund, or a credit card. Simply Money's Nathan Bachrach here with more on what this means. Good morning, Nathan.
Good morning, Karen.
Okay, so let's talk about this. The first time in a decade.
Since the Great Recession, this is the first time. Remember, interest rates went down to zero when we had the Great Recession. Now they're starting finally to move. The Federal Reserve, which is our nation's bank, their job is to keep the economy healthy. Too much cash, we have inflation. Too little cash, business doesn't grow. For the first time, they're going to raise the rate that banks charge each other by 1/4%.
What does this mean for consumers? The regular Joe out there watching today, like me, what does this mean? Well,
it means rates are going up, the cost of borrowing is going to go up, but don't run out tomorrow and all of a sudden go, oh my goodness, I've got to buy a house, I've got to do. No, but I'll tell you, here's how it will affect you. If you have a mortgage and it's an adjustable rate mortgage and it was for $300,000, that's going to cost you $35 a month more. Now, if the average mortgage is $175,000, so it's going to cost you about $1,750 or $150,000. It's going to cost you about maybe $17, $18 a month. If that's the difference between whether you should or shouldn't buy a house, then you shouldn't be buying a house to begin with.
Right. Okay. That's a minimal for most people.
Correct.
All right. So stocks.
Yeah.
I feel like this is going to really affect them.
You know, stocks have had about 10 years to get ready for this. Businesses had 10 years of cheap money to get ready for this. Just like when the Federal Reserve was pumping money into the economy and everybody said, oh my goodness, what will happen when they stop? Well, they stopped, and guess what? The sun came out. It didn't. The world didn't come to an end. I'm pretty sure stocks have figured this out, but we will see some volatility in the short term. But if you're a long-term investor, as we would say back east, don't worry about it. Don't worry about it. It's going to be okay. Things will calm down.
You say that a little too well.
Well, I know.
Okay, so credit cards, most of us have one of those.
Yes, you do. And those cards, just like at the pump where all of a sudden you hear a barrel of oil went up by a dollar and all of a sudden immediately it changes at the pump. Well, that's what's going to happen with credit cards. As soon as the Fed raises interest rates, which I'm pretty sure they'll do today, your credit card interest rate is going to go up. So if you've had a debt and you haven't figured out how to pay it, now would be the time to pay it, because otherwise you're about to start to see your interest rates when your credit cards go up. So get a plan to figure out how to pay it off.
See, I feel like that affects the most people there.
Yes, it does. And so, and if you look to jump to an introductory no interest rate where they say, 12 months, 18 months, no interest, make sure you got a plan to pay it off by the end of that 18 months. Otherwise, bang, you're going to get hit with some jumbo interest rates that will make this little 1/4% look like a walk in a park.
Okay, so what about if you have a savings account, CDs? This is good news?
Yeah, eventually. Banks, however, they're real quick on raising the cost of borrowing, but when it comes to a certificate of deposit, and those are the people that have really been paying the price for this Great Recession, that's going to take probably 3 to 6 months, and then you'll start to see the rates change.